Hey everyone, welcome back to Corporate Decoder. Today, Nuance Concentrated Value Fund just filed an N-CSR, and I am seeing some interesting performance data. Quick note, this is not financial advice, just my take on public filings for educational purposes. The fund had a rough year, significantly underperforming the market, and it is important to understand why. This is a certified shareholder report from the Nuance funds, which are part of Managed Portfolio series. Essentially, they are publicly reporting their financial health and performance. The reporting period ends on the 30th of April, 2026. Let's talk about costs first. For a hypothetical $10,000 investment in the institutional class of the Nuance Concentrated Value Fund, the costs for the past year were $110. That's about 1.03% of the investment. For the investor class, the cost was slightly higher at $136, or 1.28%. It's standard for different share classes to have different costs, usually because of things like sales charges or different services offered. Now, for the performance, the report says the past year was challenging. The fund felt that the broad market was really only interested in artificial intelligence, financial speculation, the Mag 7 stocks like Nvidia and Apple, and companies that weren't even making profits. This made it a tough environment for their specific investment strategy. One of the biggest reasons for this underperformance was the fund's heavy investment in the consumer staples sector. While some companies like Estee, Lauder actually did okay, others like Clorox, Henkel, Kimberly-Clark, and Beiersdorf really dragged the performance down. The fund managers believe these companies have strong risk reward opportunities, so they are sticking with them. On the positive side, stock picking in the financial sector did well, especially Northern Trust Corporation. However, the fund's overweight position in utilities hurt performance. California Water Service Group was specifically mentioned as lagging the market, even though the managers still see it as a good risk-reward investment. In industrials, the fund did well, particularly with holdings in ground transportation like Werner Enterprises. But in materials, Aptar Group underperformed. Healthcare was a bright spot, with Hologic, Thermo Fisher Scientific, and Waters Corporation contributing positively. The fund also benefited from being underweight in real estate and consumer discretionary, meaning they owned less of those sectors than the overall market, which turned out to be a good move for performance. On the flip side, being underweight in communication services, energy, and information technology negatively impacted results because those sectors performed much better than the fund expected. And finally, just holding cash also hurt performance because that cash wasn't invested in the market when it was booming in certain areas. Looking at the past 10 years, the performance paints a different picture. The annual average total return for the institutional class was 6.74%. Compare that to the S&P 500 total return, which was 15.26%, and the Russell 3000 value total return at 11.17%. This clearly shows the fund has not kept pace with broad market indices over the long term. As of the 30th of April 2026, the Nuance Concentrated Value Fund had $42.9 million in net assets among 32 holdings. The net advisory fee was over $500,000, and interestingly, the portfolio turnover was a high 114%. A high turnover rate means the fund managers are buying and selling stocks quite often, which can sometimes lead to higher transaction costs and potentially taxes. Let's look at where the money is invested. The top holdings as of the 30th of April 2026 were Qiagen NV at 9%. Clorox Company at 8.9% and Beiersdorf AG at 8.8%. You can see a concentration in consumer staples and healthcare companies, which aligns with the performance commentary. This filing also covers the Nuance Mid-Cap Value Fund. Similar to the Concentrated Value Fund, performance was called challenging for the past year, with similar reasons cited for underperformance. For the institutional class of the Mid-Cap Value Fund, costs were $101 on a $10,000 investment, or 0.94%. The investor class had higher costs at $127, or 1.19%. And the Z class, which is usually for larger investors or specific platforms, had the lowest costs at $85, or 0.79%. The performance discussion here echoes the findings for the Concentrated Value Fund. Consumer staples again was a detractor, with Clorox, Henkel, Kimberly-Clark, and Beiersdorf weighing on results. Financials, led by Northern Trust, helped utilities. Particularly California Water Service Group was a drag. Industrials were positive with Werner Enterprises. Healthcare was a positive contributor with Qiagen NV, which they've added to materials. Specifically, Aptar Group underperformed. They also benefited from being underweight in real estate and consumer discretionary. but hurt by underweight positions in communication services, energy, and information technology. And again, cash was a drag. Looking at the 10-year average total return for the institutional class of the mid-cap value fund, it was 7.80%. This also lags behind the S&P 500 at 15.26% and the Russell mid-cap value total return at 10.32%. The Z class did slightly better over 10 years at 7.16% since its inception in May 2017, but still significantly behind the market indices. The mid-cap value fund is much larger, with $289.5 million in net assets. It holds 55 stocks. The net advisory fee is a substantial $3.1 million. The turnover rate here is 110%, also quite high. Top holdings for the mid-cap value fund include California Water Service Group at 7%, Chiagan NV at 6.7%, and Martin Transport Limited at 5.8%. This portfolio looks more diversified than the Concentrated Value Fund, but still features some of the same names like Clorox and Beiersdorf. There are some significant changes noted for the Mid-Cap Value Fund regarding expense caps. Starting the 28th of August 2025, the investment advisor is agreeing to waive fees and reimburse expenses to ensure the fund's operating expenses don't exceed certain percentages of its net assets. For the institutional class, this cap is set at 0.95%. For investor class, it is 1.20%, and for Z class, it is 0.80%. These caps are slightly higher than the previous ones, but still aim to control costs for investors. Let's dive into the financial statements of the Nuance funds as of the 30th of April 2026. For the Concentrated Value Fund, total assets were about $45.2 million, with liabilities around $2.3 million. This leaves net assets of approximately $42.9 million. The Mid-Cap Value Fund is much larger, with total assets of $293.3 million and liabilities of $3.8 million for net assets of $289.5 million. Looking at the statements of operations for the year ended the 30th of April 2026, the Concentrated Value Fund had total investment income of about $1.7 million. Expenses were around $928,000, and after some fee waivers, net expenses were about $801,000. This resulted in a net investment income of around $850,000. On the gain side, they had realized gains of nearly $9 million and unrealized appreciation of $2.5 million, bringing the total increase in net assets from operations to over $12.3 million. For the Mid-Cap Value Fund, the numbers are significantly larger. Investment income was over $10 million. Expenses were around $4 million, and after fee waivers, net expenses were about $3.9 million, leading to a net investment income of nearly $6 million. They saw realized gains of $34.3 million and unrealized appreciation of $23.4 million, resulting in a massive increase in net assets from operations of over $63 million. The financial highlights section gives us a per share view. For the institutional class of the Concentrated Value Fund, the net asset value per S-Share ended at $12.70. Their total return for the year was 13.17%. However, over the past 5 years, the total return was negative at minus 0.74%. The ratio of expenses to average net assets after waivers was 1.03%, which is a significant cost for investors. For the institutional class of the Mid-Cap Value Fund, the net asset value per S-Share ended at $12.79 with a solid 14.01% total return for the year. But like its counterpart, the 5-year return was only 1.01%. The expense ratio here after waivers is a much lower 0.94%, which is more competitive, especially for a fund of this size. In the notes to the financial statements, we find important details. The funds are part of managed portfolio series and are registered investment companies. They follow GAAP and comply with the Internal Revenue Code to qualify as a regulated investment company. The security valuation process is critical. Investments are recorded at their estimated fair value using a hierarchy of level 1, quoted prices, level 2, observable inputs, and level 3, unobservable inputs. For both funds, all investments at the 30th of April 2026 fell into level 1, meaning they are valued using readily available market prices. The investment advisory fee for the Concentrated Value Fund is 0.85%, and for the Mid-Cap Value Fund, it is 0.75%. Importantly, the advisor has contractually agreed to waive fees and reimburse expenses to keep operating costs capped at specific percentages for each share class. For the institutional class of the Concentrated Value Fund, this cap is 1.03%. For the institutional class of the Mid-Cap Value Fund, it is 0.95%. These caps are crucial for investors as they limit the impact of management fees on returns. The report also mentions that the Mid-Cap Value Fund recouped $17,301 of previously waived expenses. Toward the end, we see tax information. For the Concentrated Value Fund, the net unrealized appreciation on investments was negative $2.4 million. This means the unrealized losses were greater than the unrealized gains. For the Mid-Cap Value Fund, the net unrealized appreciation was over $3.8 million. This indicates that, on paper, the unrealized losses in their portfolio outweigh the unrealized gains. Finally, a key part of these reports is the board's approval of the investment advisory agreements. The trustees reviewed the performance of both funds. For the Nuance Concentrated Value Fund, they noted that it had underperformed its peers and benchmark indices for all periods presented up to the 30th of September 2025. Still, the fund did achieve positive total returns in most periods. For the Nuance Mid-Cap Value Fund, the trustees also found underperformance against its peers and benchmark index. Despite this underperformance, the trustees concluded that the advisory fees were fair and reasonable, considering the services provided, the size of the funds, and the fact that the advisor had agreed to expense limitations and waived fees. What is my take on these filings? Both funds, particularly the Concentrated Value Fund, have really struggled to keep up with the broader market over the past decade. The performance commentary highlights a challenging year, and the long-term numbers aren't much better. While the expense ratios are being managed through waivers, the consistency of underperformance is a significant concern. The fact that they are sticking with underperforming sectors and individual stocks suggests conviction, but investors need to be aware that this strategy has not produced market-beating returns. The Mid-Cap Value Fund, while larger and with a lower expense ratio, also shows lagging performance relative to its benchmarks. The trustees' decision to reapprove the advisory contract despite this underperformance suggests they see long-term value and perhaps a different path to generating returns. However, for the average investor looking for market-beating growth, these reports raise questions about whether these funds are the right choice. The key risk I am watching is whether this concentrated value-focused strategy can adapt to changing market dynamics, or if it will continue to lag. What I am actually looking for is a clear turnaround in performance or a significant shift in strategy that aligns better with market trends. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.